So that's the first example. What I'm going to do is I'm going to show you a few examples, then I'm going to go into the 1 minute entries so you can see how we can use the same framework and understanding to build entries as well. Remember, we had this area which was that 14 pip area, which is the area that we were looking at. Price comes into that mitigation. We've seen that bullish order flow. We've added on our framework and we've found a buy low location in this A to B price range. But you can see how it's repeatable, it's consistent and very simple. Stop trading in the slaughterhouse. In today's video, I'm going to be showing you how to get the perfect entry every single time using our location concept that you can learn at Not Just a Trade. My name is Luke Burton, co-founder of Not Just a Trade. I've been hitting double-digit percentage returns every month using the concepts and framework I'm going to show you in today's video. Okay, so today we're going to be using this framework that we have here. So just pause the video now. This is a fib retracement tool, and obviously you can add all of these in if you want to use this tool after viewing this video. What we're going to be using this tool for is to find buy low and sell high locations inside a sideways range and inside an A to B price range. These are going to give you the highest probability trading locations for your entries and stop you trading in low probability locations. So what most people use is the premium and discount tool, but what that doesn't account for is the middle of the range. And what we found is a lot of people try to trade middle of the range when the best locations are at the edges overall. So what we've done is we refined this framework to understanding where the edges are, the top 25 and bottom 25%. And what we've done is we use this area in the middle to understand this is middle of the range. This is where they're going to entice you to get involved in positions, but these are going to be the lowest probability positions overall. So this is called the slaughterhouse. Okay, so if you have a look at the chart now, what we can see is the framework being applied to the understanding of how the market actually moves. So if you haven't seen our market structure video, have a look at that. So we have an understanding that price is either trending here, where we're making lower highs and lower lows overall, or we're moving sideways, which means we're not making lower highs and lower lows, we're just contained in a sideways range, or we're just initiating, which means price is moving very aggressively in one direction or the other. This is key, and this is very important to understanding how to use the framework. These are the fundamentals first, and then you apply the framework on top of this, because you have to understand what phase of the market that we're in before you can apply your framework so that you know how to trade that phase of the market. So as we see here, we've got a sideways range here between the candles. We initiated to the upside, we pulled back in, we've mitigated. So we expect that this next phase of price is going to be that initiation phase. So we know price isn't going to pull back deep. So what we would expect is that price is going to create new ranges and see continuation. So that's all we want to do. We just want to find when price is contained between a high and a low in price, and then we add on our framework so that we can find buy low and sell high locations overall. So even though price may be moving very aggressively and we might be at high prices, because we know the phase of the market, we can trade these moves at high prices and then see continuations. As long as we can apply our framework onto price, then we can always find buy low and sell high locations to look to take trades from at great location. This will dramatically improve your entries because you'll stop trying to chase the market in the middle of the range or too high, and you'll only be looking in a specific area to get buy low continuations to the upside. So as we can see on the chart now, we had a sideways range where price was contained between the high and the low. And as we can see, we have a sideways range in here as well. So we can apply our narrative and our understanding to what price is doing. Sideways range, initiation, mitigation, continuation. So we know that this is the general area that we want to be looking for our trades. So we already know to stay out of the middle of the range. This is where there's going to be tons and tons of positions and opportunities. But the idea and the psychology behind the middle of the range is that the BFIs want you to be involved. This is where the most volume is going to be transacted in the middle of the range, but the best opportunities are going to be at those edges. Price isn't going to stay at the edges very long at all, but these are going to provide the highest quality opportunities with the highest risk to reward opportunities as well. So here we can see we have a full-bodied OB inside the range. This is a buy order inside the range, which we expect to be back inside the sideways range where the orders are created. They initiated price, which means they showed the direction of the range. And now all we're doing is looking for that pullback continuation. You can see how refined our entries are just from understanding three things: understanding what market phase we're in that initiation phase, so we're not going to pull back deep, so we expect new ranges. We understand that we've got our concept of range, initiation, mitigation, continuation, which is giving us that bullish narrative, because what it's showing is bullish order flow in the market. Range is where orders are created. Initiation shows the intention of that range. When we pull back and mitigate into that range, that's our opportunity to get involved in that intention, and when we continue, we have a target for our next continuation. Then we apply our framework to make sure that we're buying low, and we have high probability trading ideas built just off three key fundamental facts of the market. Once we have this information and we've applied our framework, then we look at entering this trade. And this is a really key part before the entry. Entry is supposed to be easy. It's the icing on the cake. Finding the high probability trade ideas using the concepts, that's where the work comes in. But actually entering these trades is following your narrative at low prices, playing a buy continuation. We've refined our area on the charts to have a 9 pip area. So this is how we're able to get those 2 to 3 pip stops, because the area that we're looking at is so small already. Now, we've built our trade idea, we've built our understanding, we've built our direction in price, we've added on our framework. So when it comes to the entry, it's literally about just following that direction and getting a setup in that direction, because we've done all the work so far. So that's the first example. What I'm going to do is I'm going to show you a few examples, then I'm going to go into the 1 minute entries so you can see how we can use the same framework and understanding to build entries as well. So cool, so now we've gone from a ranging market where prices contained sideways and we've initiated to the upside. So now we have an A to B price range. Now we can use the same framework and understanding to take trades at great locations following the trend. And we've also got range, initiation, mitigation, continuation. So we know that if we follow through, this high is going to become that next target for price. So we add on our framework. We don't want to be taking trades in the middle of the range. This is the slaughterhouse. A lot of people will be looking, inside this wick for entries, getting stopped out, getting frustrated, and then jumping back into the next trade. What we want to do is only look for the highest probability locations, which is that bottom 25%. And again, our area that we're looking at is 14 pips. Now, if we go back into the sideways range that we have here to the left, which I'll draw on now, sideways range, we know we're looking inside this sideways range in a 14 pip area for our entry, for continuation. So even if you wanted to take this as a reaction, here you can have a 7 pip stop and you can still take a massive percentage out of the market. What we do is we zoom into this area and we go onto the 1 minute time frame, and all we do is look for continuation here to the upside. That's all we're doing. So again, we've got another full-bodied OB inside this range, which is that buy order created inside the range. So now we have our defined area. It's just about going down onto the 1 minute chart and looking for continuations to play this to the upside. Now, people say that our risk to rewards are stupid, but if you add on these frameworks and you understand that if price reacts and follows through, means this high is going to get taken for that range, initiation, mitigation, continuation play, look how much room there is to the upside to take, 20, 30 pips out of the market. It's 44 pips just to the high. So if we're getting into trades in continuations in this refined area and we're looking for our setup on the 1 minute chart, remember this is the 15 minute chart. If we're looking for our setup on the 1 minute chart, the stops are naturally going to be smaller because we're playing a smaller area. So that's how we're able to get those 1 to 10 risk to rewards out of the market. So I'm going to go down here on the 1 minute chart now, and you can see how we can use these exact same frameworks and understandings to find an entry. And the market is fractal, so exactly the sort of price delivery that you're seeing here on the 15 minute can be applied to the 1 minute chart. The same framework, the same understanding, the same entries, the same concepts, and the same fundamentals of how the market moves can all be applied to the 1 minute time frame. So now down here onto the 1 minute chart, I've just zoomed out so you can see that 15 minute A to B here. We're at the buy low location here, and we're at our previous point of mitigation, which we drew on, which was that full bodied sell to buy. So now all we're going to do is look for entry. I want to see price show me some sort of bullish price delivery or some sort of bullish order flow so that I can get involved in this market. So down here on the 1 minute, we can see that price is inside that mitigation now and we're moving sideways. So again, if I was going to trade this specifically as a sideways range, you can add on your framework again and find buy low locations inside the sideways range or sell high locations inside the sideways range here as well. So we can apply the same framework as we done on the higher time frame to find great trading locations and really refine the entry and the stop down to a very, very small amount. So let's just play this forward. So we see we broke out of the sideways range now, so we're no longer in a sideways range. What we're in is an A to B price range, A to B. As we see here, the same understanding as we had before on the higher time frame, we can use that same understanding here. So now we've gone from a sideways range, so I'll draw that as a sideways range now. Price was contained between this high and this low, and now we've initiated to the upside. So now we can apply on our framework of the A to B price range here, A to B. Now we can look at buy low locations and stay away from the middle, which will be the slaughterhouse. So as we see price is pulling back into this range, we can have our entry at the buy low location, stop underneath the low at 2.9 pips, and obviously then we're targeting that 1 to 10 risk to reward. Now, again, 1 to 10 is not even at the swing high. If you wanted to play this as that continuation for that higher time frame move, you've got a potential 1 to 16. Now, we always stick to 1 to 10, that's our framework, but you can adjust this take profit to match what you're seeing and your understanding in the market. If you consistently wanted to go for the swing high inside these moves, then obviously you can take more profit out of the market. It's just about using the same repeatable framework for every single entry and understanding. So again, we see here, price would have pulled back into that buy low location, and then you could have taken that as a continuation here to the upside and played that as a continuation to the upside as well. So it's really about understanding the framework, and the entry then is just about trading in a good location. Remember, we had this area which was that 14 pip area, which is the area that we were looking at. Price comes into that mitigation. We've seen that bullish order flow. We've added on our framework and we found a buy low location in this A to B price range, A to B, which is the same framework we used to build this trade idea in the market. And now all we're doing is applying the same concepts and understanding to refine our area even further. It's the same understanding, it's the same concepts, it's the same fundamentals. All of these put together is how you build great trading ideas and high probability trading ideas. And of course, we know this one went on to play out and saw continuation to the upside, and that hit that 1 to 10. But you can see how it's repeatable, it's consistent, and very simple. So that's another example there for you. We're going to go back to the 15-minute chart now, which will be our intraday higher time frame, and now we're going to see how we can use the same framework and understanding to build great trading ideas and high probability trading ideas. So just zooming out now, all I've done is I've just drawn on all the sideways ranges when price is contained between a high and a low here. So you can find buy low or sell high opportunities inside these ranges. Again, not all of them play out. You have to follow a narrative of range initiation, mitigation, continuation, and that's why our RIMC method works so well, because you can use it for entry but also to understand direction in the market. And then when you apply on this framework, you can find those buy low locations in abundance. Look at the amount of trades that you can look to get involved in as continuations here, just by applying the framework and understanding RIMC locations in the market. There is an abundance of trades here, and our risk to rewards are 1 to 10. So if you imagine, if only 50% of these trades played out, you would still be massively in profit. So I'm going to briefly skip through these on the 15-minute chart so you can just see how I'm applying the framework overall to sideways ranges and price ranges, and then we're going to have a look at one more example here as well. So we can see here that price is contained between this high and this low overall here. So this would have been buy low locations overall to take continuations. Here you would have also got another continuation here that you could have potentially played. Price broke structure here to the upside. Here we initiated to the upside, we moved again into a sideways range. Again, these were multiple opportunities here to look for buy low locations to trade this here to the upside. We then saw price initiate to the upside. Again, we started moving sideways. We was contained between this high and this low. This was a great buy low location to play as a continuation here in London, just applying the framework. Again, here in New York, we moved sideways. So again, we apply on our framework. These would have been the buy low locations inside this sideways range. And those traders that know how to find sideways ranges, which you can find in our course, will understand how you could have traded this and understood that it was a range as it was happening. Next day, again, we get sell high locations overall, and these were continuations that we got involved in here as well. I know Chuck's got involved in a buy low location here to the upside, and then when price broke out of this range, we moved into a new phase of the market. We created a new sideways range, and this is where I got involved in a nice sell high location to the downside. So it's about understanding what sort of market phases we're in first, because these are the fundamentals. You need to understand what you're trading. Then you apply on the framework and you use RIMC as your guide and your direction. So as again, we see here, price creates a sideways range overall. We have sell high locations, range, initiation, mitigation, continuation. So you see, we can apply on the same framework and understanding to build these great trade ideas. And again, same here. This is where we're going to go into our next example now. So we have price contained here in a sideways range. We initiated to the downside. We can see that we have this whole buy to sell inside the range. This needs to be mitigated out from. So we have our area now. We have our refined area. When price comes back into this small area of 20 pips, we already have our refined area inside the sideways range now, which will be this top area, which is 12 pips. So now we've gone from having a massive area of this A to B, and if you had just used that premium and discount, your area would have been absolutely massive. Your area for trades would have been nearly 40 pips. Now, because we've applied this refined framework, we can now look at a 12 pip area to find our entry. So now let's zoom into entry. So now down here onto the 1 minute chart, I'm just going to zoom out so you can see that 15-minute A to B price range. We're at our sell high location now. We've waited patiently for that. All we're looking for now is our entry. So what I'm going to show you is what would have happened in real time so that you can see and understand how price moves and how trading actually is. So again, we get a sideways range here. Price is contained sideways. We initiate to the downside. If we was to apply our framework onto this trade, we would be looking at that sell high location to take a continuation to the downside. So what I'll do is I'll do that now, exactly how we would have done. Our stop would have been safe at a 2.5 pip above this high. And of course, we're looking for that 1 to 10 risk to reward as always. Now, this is a great trade setup in a great location, playing a narrative of lower prices. Now let's just play this forward. So price tags you into the trade, moves away, and you get taken out. Now, does this mean that it's not a bad trade? Does this mean that you're a loser? Does this mean that the concepts don't work? No, this is probabilities. This is what trading is. It's understanding that not every single trade will play out, but the trade idea can be fully stacked in your favor. And that's really important to understand. We don't trade one trade at a time. This trade is a repeatable framework that we can use over and over again. We've just seen the exact same framework used in a buy opportunity that hit a 1 to 10. This one is a 1% loss. So you're still up 9%. This is just the understanding. Trading is not just one trade at a time. Trading is taking the same entries, the same framework, the same understanding, applying probabilities, which means you're not looking at trading as one trade at a time. You're actually looking in a series of 10 or 20 trades. You're executing that same setup 10 times perfectly, and then you get the result at the end. So let's just play this forward. So that would have been a 1% loss on that same framework and same understanding. That's fine, as long as you perfectly executed that. That's absolutely fine. So let's play this forward now. So what does price do now? We move back into that sell high location, and what happens? We get exactly the same setup at a great location here, sideways range, initiation, mitigation, continuation. So we apply our same framework onto this. We find our sell high locations in the market, which will be here. We add our entry on. Again, our entry is now 2.5 pips again, and our risk to reward, again, as always, is a 1 to 10 risk to reward overall. So now we play price forward. Again, we've got our new A to B. Price has broken this low. This doesn't mean that this is not a trading idea anymore. This is the same trade. We apply our framework to the same area. We just refine our stop. We're still playing that range Initiation, mitigation, continuation to the downside. Nothing has changed. So we get tagged into this trade here. And what do we see with this trade? This trade goes on to play out. So as we can see, it doesn't matter that we've taken this trade here, which is exactly the same setup as the trade that we have here, and it hasn't played out. What's important is that we've taken the same trade again, the same understanding, and the trade idea is the most important. We're at our sell high location, at our edge, we're at our previous mitigation, we've seen bearish order flow in the market, we've got our A to B price range, we've sold high on the higher time frame and the lower time frame, we've built our high probability trading idea, one's played out and one hasn't. So let's just play this forward. Again here, speed this up as well. Here to the downside, and as we can see, this trade plays out for that continuation to the downside here. And we even get another opportunity and multiple opportunities in this sell high location to take more trades. So as we see here, we get another sideways range here. We initiate to the downside. We pull back into where? Our A to B price range, sell high location. And this could have been another potential entry that you would have taken if you missed the first one. And this would have been a 3.6 pip stop, and you could have played that as a continuation to the downside. So we can see as long as we're still in this sell high location, we still are looking for the same entries and same opportunities using our repeatable framework. So we see here, price goes on to play out for that 1 to 10 continuation to the downside. So it's important to understand, we took a loss here and we took a win here. Now, as long as you've executed both of these trades perfectly, what's important is that we have high risk to rewards of 1 to 10, so that these trades, when they lose, it doesn't matter. It's a part of probabilities, it's a part of the game, it's a part of trading. The winners are always just around the corner because we have built our high probability trading idea from the higher time frame, and we're executing that in our refined entry using our same repeatable process. Remember, the market's a fractal. We're using our same process to refine our stop to a specific area, which is high probability on both higher time frame and lower time frame. Thank you all for watching. If you want to find out more about how we trade these markets, you can visit our website at notjusttotrade.com. You can also contact us on Instagram at notjusttotrade. If you enjoyed this video, like and share and leave us a comment, and we'll catch you on the next video.